right. Good afternoon, everyone. We'll give everybody just a few more minutes. I know we're missing a few people that probably just going to trickle in a minute or two, and then we'll get started. All right, so we'll just go ahead and get started with some opening items, and then we'll go ahead and get started with our presentation. But thank you, everyone, for hopping on today. For those that I haven't met before, my name is Nikki Kazahaya. I'm the community manager here at SafeGraph. Before we switch over to Karen's presentation, I just want to make sure that we go over some events that the SafeGraph community will be hosting in the coming weeks and months. We'll be hosting a seminar by James Kyle of the SafeGraph engineering team, who will be showing us best practices for working with point POIs, which is a newer product that we're offering from SafeGraph. Still finalizing the details on some of that around that event. So stay tuned for more information, and we'll be sure to circulate that info to you. Looking a little bit further out on October 20th, we'll be having an event announcing SafeGraph's global brands product. So join us to hear from SafeGraph's product leaders about our global strategy and the technical details of our global brands data set, as well as best practices for operationalizing global data from @Scale's VP of Solutions Engineering. So I'll be sure to drop that info in the chat here in a minute. If this is your first time joining us, just to go over the format for the presentation today. So here in a minute, I'll introduce our speaker, Karen. We'll pass it off to her, and we'll have plenty of time at the end for Q&A. However, feel free to drop any questions you have during the chat or during the presentation in the chat or the Q&A, and we'll be happy to grab those. For those that are just watching the recording, you can always reach out to me or post any questions on the help channel in the SafeGraph community, and we'll be sure to get you in touch with Karen if you have any follow-ups after this presentation. So I'll go ahead and introduce Karen. Karen is visiting Indiana University. She completed her PhD in accounting at University of Southern California and has previously worked at Emory University and PricewaterhouseCoopers LLP. Karen is an active certified public accountant in the state of California. So thanks so much for hopping on, Karen. I will pass things off to you.
Thanks, Nikki, for the introduction. And thank you so much for giving me the opportunity to present my research today. I'm really looking forward to getting feedback and would especially welcome comments or feedback from people that have used or worked with SafeGraph data. So this project is titled Customer Loyalty and the Persistence of Revenue and Earnings, and it's co-authored with Hung De Jin and Steve Steuben from the University of Utah. We're currently working on a major revision, but my presentation today is based on the last version of the paper that was distributed and doesn't include our updates. So I'm presenting what we have as of now, but some of the things that I mentioned at the construct level might change in future revisions. And I'm curious to hear your thoughts so that we can consider them as we're revising the paper. So the motivating question of our study is we were interested in examining whether we can use customer data to understand the nature of a company's revenue stream and its implications for stakeholders. So we set out to answer two broad research questions. The first was to look at whether a company's revenues and earnings are more persistent when they come from a more loyal customer base. And this is a different dimension of persistence that we're looking at, a different factor that can affect persistence because most of the previous research has really focused on fundamental factors. And although we are primarily interested in revenues because of its more direct relationships to customers, these effects might trickle down to earnings. So that's why we're also looking at earnings persistence. The second major research question that we addressed in this project was to see what the implications of customer loyalty is for managers, investors, and analysts. And for managers, we specifically look at how loyalty might be associated with capital investment decisions. And for investors and analysts, we were interested in seeing whether they incorporate loyalty into their trading decisions and forecasts. So just to give you some brief background, there has been quite a bit of marketing research on customer behavior. In terms of definition, customer loyalty is this emotional attachment to a product, service, brand, or business. And previous studies have shown that customer loyalty is typically going to result in more referrals to other customers and repeat purchases. So this generates higher revenue, which leads to greater profitability. These customer loyalty also results in less spending on getting new customers. So that means we're going to have lower costs or expenses. Now, one limitation of a lot of these studies is that they typically rely on case studies, survey data, or other small sample evidence. So the one major innovation in this study is that we were able to use SafeGraph data, which provides a very large data set on observed consumer behavior. So for our sample, we are using SafeGraph data to construct the customer loyalty measures. For our financial statement variables, we are using data from CompuStat. We use CRISP for our stock returns data and IBIS for our analyst forecasts. We start the study in January 2018 because that's the earliest SafeGraph data we have available. And our study goes through September 2019. And we stop there because we look one quarter ahead to examine revenue and earnings effects. So that financial statement data goes through the end of 2019. And we ended it there so that it doesn't include the effects of COVID. However, we have found that our results are robust to adding 2 more quarters through the end of June 2020, but the effect is going to be smaller during the pandemic. Our final sample includes 285 companies and approximately 1,800 company quarter observations. So this is some of the information or data that we used from SafeGraph. Specifically, we were using SafeGraph's total number of visits, the number of unique visitors, the number of visits by the day of the week, day of the month, and the duration of the visit. And we are using those different measures to construct 4 different customer loyalty measures. The first loyalty measure that we constructed is something that we refer to as the stability of customer traffic. And the idea behind this is that if the store has a more regular or steady stream of customers, that's going to lead to more persistent revenues. The second variable that we create is based on repeat customers. And the idea is just that if customers are returning to the store, they're more likely to buy again in the future. The third customer loyalty measure that we construct is a weekday versus weekend shopping metric. And the idea behind this is that prior research has shown that weekday shopping tends to be more functional, whereas weekend shopping is going to be more recreational. So our weekday shopping metric is going to lead to more persistent revenues. The last metric we construct is based on the visit duration. And the idea behind this is just that if customers are more loyal, they're more likely to stay longer at the store. They're also more likely to visit again in the future. Right, so using these 4 different measures, it's likely that there's going to be some common overlap between those 4 metrics. So what we did was we used the principal component analysis in order to construct this customer loyalty variable. So what the principal component analysis does is it constructs a variable that summarizes the common information across our 4 proxies for customer behavior. And we found that the first component here explains 68% of the variation in those 4 variables. So going forward, to simplify our analysis, we focus more on using this principal component to perform most of our regression analysis. So this is the general model that we use for our main test. And for this test, we are interested in examining the interaction between our customer behavior measures and revenue persistence. So the coefficient of interest is going to be that interaction term, or beta 2, which is the interaction between the customer loyalty measure that we constructed and the change in revenues in the current period. And we're interested in seeing this association with revenue in the subsequent period. In our model, we also include controls for firm characteristics and also some geographical characteristics. We also include firm fixed effects. We did this because when we were looking at the different firms within an industry, for example, it was hard for us to see how easily comparable those firms might be. So we thought that the best specification would be to look at variation in customer behavior within a firm. So our main model uses firm fixed effects. We also include quarter fixed effects to control for changes over time. Our main prediction here is that beta 2 is going to be positive if revenue persistence increases with customer loyalty. Okay, so this table here tabulates our main test along with some additional tests, but the results of the test or of the main test is presented or tabulated in the second column. And in the second column, the coefficient of interest beta 2, we see a significant positive association. So in terms of economic magnitude, this means that if there was a one standard deviation increase in customer loyalty, we would see a 3.9% increase in revenue persistence. Now, I had mentioned earlier that we had included firm fixed effects because we thought that it would be most meaningful to see how customer behavior affects revenue persistence within a firm. But we also conducted this test using just industry fixed effects, which means we're comparing this between firms within an industry. And that's presented in the third column. And there we continue to see this significant positive association. Now, the last two columns present a cross-sectional test. And in this test, we were interested in seeing whether the relationship between customer loyalty and revenue persistence is going to vary based on performance of the firm's revenue, right? Because there's prior literature that suggests that firms that are experiencing losses are going to have less persistence. And what we found was pretty consistent with the prior literature. We found that the positive association between customer loyalty and revenue persistence is really driven by firms with positive revenue growth. Now, we were primarily interested in studying the effects of customer behavior on revenue because customer behavior is going to directly affect your revenues. However, because of how the financial statements are set up, revenues will ultimately affect earnings. So we also wanted to see if customer behavior metrics could be used to tell us anything about earnings persistence. So that's what this next set of tests is tabulating. The model that we used for this test is very similar to the revenue model. The only difference is that we replaced the change in revenue. We use change in EPS instead of change in revenues in the earnings persistence model. And in this model, again, we tabulated our main results in the second column. And here we continue to see that customer loyalty is positively associated with earnings to persistence. And again, these results are driven by firms that are experiencing earnings growth. So because of the earnings we see a significant positive association with revenue persistence as well as earnings persistence. So kind of to delve into what's driving this relationship, we next look at how it's related to expenses. So expenses are costs that the firm has to incur, right? So we look at total expenses, which is also going to include the expenses that's incurred in producing the good and delivering the service. But we also focus just on selling, general, and administrative expenses, or SG&A. And that's going to include your everyday operating expenses, but it doesn't include the production and manufacturing costs. So that means your SG&A cost is just going to focus on items such as rent, salaries, advertising, and marketing expense. So when we look at the relationship of customer behavior and its interaction with the persistence of expenses, we saw that it's not associated with total expenses, but it is positively and significantly associated with selling, general, and administrative expenses. So that tells us that the relationship that we had documented between customer behavior and earnings persistence is really working through revenues. And so the most meaningful So customer behavior is going to be most meaningful in helping us understand revenue quality. And also, it also shows us that SG&A expenses is also going to be relevant to that. So that was the first research question we had set out to answer. The second research question that we wanted to address was that now that we know that there's this relationship between customer behavior and revenue and earnings persistence, what does this mean for stakeholders, right? So how do managers use this information? How do investors use this information? And what do analysts do with this information? We're going to start out with managers, and with the managers, we're interested in looking at answering two specific things. First, we wanted to see if customer behavior is associated with greater sensitivity to investment opportunities. And the second question we look at is whether customer behavior is also associated with higher levels of capital investment. And then finally, we're going to look at how market participants such as investor and analysts incorporate the customer behavior information into their trading decisions and forecasts. So for the capital investment sensitivity analysis, here we're interested in looking at the association between investment opportunities in the current period and capital investments in the subsequent period. And the idea here is that managers might delay or forego potentially profitable investment opportunities when they're uncertain about investment incomes, right? So for example, let's say we have a manufacturing company and they're debating whether or not to buy a new machine because they're not sure about customer demand in the next period. So we are expecting that companies with higher levels of customer loyalty, they're going to have less uncertainty about their returns from capital investment. So if that was the case, we would expect to see a positive coefficient or on the interaction between capital investments opportunities, which is measured by Tobin's Q, and interaction with customer loyalty and how that affects subsequent period capital investments. If this is not the case, we're going to see a negative coefficient, and that means customer loyalty decreases with uncertainty. The second model that we run with managers is we look at whether customer loyalty actually affects levels of capital investment. And the idea here was that it's possible that any increases in investment sensitivity might be offset by fewer opportunities. So this additional test will give us a better sense of whether customer loyalty actually is correlated with the level of capital investment. And here the coefficient on our customer loyalty measure is going to be positive if customer loyalty is associated with higher levels of capital investments. So this table here summarizes those two models that I had just discussed. The first column is the results from the capital investment sensitivity test, and the second column summarizes the capital investment levels test. And in both of these, we see significant positive associations. And from kind of takeaways, this is telling us that if there was a 1 standard deviation increase in customer loyalty, this would result in an increase of 5.6% in investments. So the takeaway from these two analyses is that it's apparent that managers are using the customer behavior information in their capital investment decisions. So then now we turn to see how do other market participants, such as analysts and investors, and we're interested in seeing if they incorporate that information into their decision-making process. So to look at investor incorporation of this information, we use something, we're looking at this test using earnings response coefficients. And this procedure is generally telling us how does the market respond to an earnings surprise, right? So to run this test, we're looking at how customer loyalty interacts with our earnings measure and how that's associated with actual returns. So with this test, we are looking at the earnings response coefficients in two different periods. In the first column, that is the association with returns in the current period. And in the second column, that's association with returns in the subsequent period. So if investors were incorporating customer behavior measures into their trading decisions, we would have expected to see a positive coefficient. But here in the first column, we see a significant negative coefficient. So that means that investors are not pricing customer loyalty behavior in their investing decisions. And this is apparent because it results in predictable stock returns in the subsequent period. So the takeaway from this is that investors don't seem to be incorporating customer behavior information into their investing decisions in a very timely manner. So then we turn to look at how or whether analysts are using this information in their revenue forecasts. And again, we're looking at the interaction between the customer loyalty measure and the change in revenue, and seeing how this maps into the analyst revenue forecast errors. And the idea here is that if you see a positive coefficient on the interaction term, that means that analysts are underestimating the persistence of revenues when customers are more loyal. And that's exactly what we find. I mean, so the top half of this table here shows the association between customer loyalty and analyst revenue forecast errors. The bottom half of the table shows the relationship with earnings forecast errors. And we see that there's a significant positive association with both. So this is telling us that analyst revenue forecasts are overestimating the persistence of revenues when customer loyalty is low, and they're underestimating the persistence of revenues when customer loyalty is high, which means that analysts, we've seen that customer loyalty is associated with revenue persistence, but analysts are not incorporating this information or this effect into their forecasts. So to summarize our findings, we found that when a firm's customers are more loyal, both revenue and earnings are more persistent. The firm's capital investments are higher, which are decisions that managers are making. However, investors persistently underreact to earnings and are positively surprised at the subsequent earnings announcement. We also find that analyst revenue and earnings forecasts are too low. So we have a couple of caveats. Our measure of customer loyalty is limited by the data we have available. So we are only able to capture in-person traffic. We're not able to view online traffic, for example. So if a firm's revenue largely comes from online traffic, then this customer loyalty metric is not going to be meaningful for those types of firms. In addition, we're capturing only in-person traffic in the United States and Canada. So again, if a firm's revenues is mainly driven by traffic in foreign locations or the locations outside of the US and Canada, then we wouldn't be able to observe that. And finally, we are using loyalty as a label. It's a label we use because we felt that it represents the consumer behavior that we've captured, but it's possible that we are capturing some other aspect of customer behavior that also explains persistence. So the conclusion of our paper was that our paper shows that revenue persistence can be explained in part by the characteristics of a firm's customer base. And the benefit of big data such as SafeGraph is that it can be used to understand not just the quantity of a company's revenues, but also the quality of the firm's revenues. And this information is going to be potentially useful to investors, analysts, as well as managers. And for marketing researchers, we're hopeful that they can also use this data to construct measures of customer loyalty or customer behavior. So thank you so much for taking the time to listen to my presentation. I am open to listening to your questions as well, but if I would also love to get some feedback from the audience or anyone that's used SafeGraph data on our customer behavior measures, right? We would love to get feedback on what you think of the measures we've constructed and whether it actually does reflect how managers think about customers. Is there any disconnect between our measure and what's done in practice? And if we're missing anything, we would love to hear what your thoughts are. Also, we would also like to get any feedback on what you think are different stakeholders that may understand or not understand these different dimensions of customer behavior.
Awesome. Thanks so much, Karen. We'll give everybody a few minutes for them to pop any questions in. Feel free to use the chat or the Q&A. Karen, I know this paper has kind of been circulating, especially a lot of people requesting it offline since they weren't able to attend it live, but we'll have to post it in our SafeGraph community and get you plugged into some of those conversations since I know it's already kind of happening over on the community side. But one question I did have, so actually here, so one question through the Q&A, we'll actually start with this one. Thanks for your presentation. I want to ask whether data showed any difference between 2018 and 2019.
So, I mean, there's definitely variation over time, right? Because when we're doing our analyses, we essentially only have 7 quarters of data, and we're looking at changes in customer behavior within a firm. I don't think we had anything specific that compares 2018 to 2019, but we can do that to see if there's any clear differences in patterns between those 2 periods.
Definitely, that'd be an interesting follow-up. So the question I had, when you were looking at some of these like visit duration times, did you do anything to filter out like really long visits to kind of possibly capture some employees?
Yeah, so this was a question I had I have tried to reach out to SafeGraph for too. And I think the data period that we were using, SafeGraph was supposedly still filtering out the employees. So in our main analyses, we didn't do anything specific, but we had also done initial analyses where we filtered out the really long visits and the really short visits. And we had filtered out the really short visits because they could be delivery, right? Delivery
Exactly.
drivers, postal, yeah. And our results continue to hold even when we exclude those two extremes.
Yeah, I think it's always an interesting conversation. I think it always comes up in the SafeGraph community. Definitely a very common question in our help channel as far as like, what is the best approach? And I don't think there is a good answer. I know seems like lately a lot of people have been using like bucketed dwell times to just filter out some of the longer visits to hopefully capture some employees. Obviously that works better in certain situations like a grocery store, but maybe not a hotel where obviously
Yeah.
those visits are going to be very long. So I just wanted to hear your input. I know it's something that's always being tossed around in the community side, so appreciate your input. If there's no other questions, again, I know a lot of people are going to try to catch this offline. So we'll be circulating the recording within the community as well. So if people are watching this not live, feel free to reach out to me or post any questions and help over on the SafeGraph community. I'm happy to get you in touch with Karen and get you plugged in with some answers. But otherwise, thank you all for hopping on today. Really appreciate everyone taking the time out of their day to attend our event. Yeah, and we will see you at the next event. Take care, everybody. Thanks.
Thank you.